Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. I drew 8 weeks ago an early July to mid-November 2023 bearish Andrews pitchfork, which is highlighted in purple on my daily chart. At the time, I was more as a way of expressing the bearish angle of attack here than for anything else, and in this, it has been accurate in showing the way lower and the bearish angle of attack, especially in the middle of March, where I draw your attention to the level at 1240, where it briefly touched the descending upper tine, currently at 1213, before pulling back. Now, the turn up at the end of February / beginning of March was both surprising and amazing, as we really had no further support below until the 61.8% absolute Fibonacci line at 1106. So from the December 2020 lows, prices turned back up, pushing through congestion in the 1161 area, then at 1161 to 1177, the 2021 lower 1181, the May 2023 lower 1193, and the December 2021 lower to 1223. Perhaps most important of all, the prices pushed up through the green highlighted slowly declining short medium moving average, currently 1189. And for a couple of weeks, the market used it as a support with the upper tine as resistance. However, last week, prices started penetrating the short medium moving average on the downside, and also the May 2023 low at 1193. Such that this week prices have pushed below both the short medium moving average and the May 2023 low, and yesterday and today attacked the 2021 low at 1181 and the lesser Fibonacci line at 1178, the start of the previously mentioned congestion between 1177 to 1161 that overall stopped the decline just over a month ago. All this did nothing to stop the purple highlighted bearish Andrews pitchfork from continuing to rule this market and showing the way lower. To add to discussion, I spoke the following 4 weeks ago, and I quote, "The one thing that should move higher might start is discussion if the November 2023 to date action is a potential descending scallop pattern. The only other thing to bear in mind is not here on this daily chart, but in Chicago soybean meal, and that is the well highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either." And that's the end of the quote. On the point of the descending scallop pattern, if prices were to continue lower down to the 1130 area, which really isn't that far, and then hesitate before breaking further down, well, that would fit in with the pattern. The alternative is an almost immediate return higher and quick break, a proper break of the purple upper tine. Right now, that does not look possible, though it might still happen. Chicago soybean meal. After establishing a horn top in this market in mid-November 2023, prices dropped with some hesitations and eventually reached the congestion down at 326.90. However, this congestion was different, as we had crossing through it at the time. This is the one at 326.90, where at the time the extension to the lower trend line, currently at 326.5, of the July to September 2021 descending triangle. I've highlighted this trend line in dark blue on my daily chart. Now, as I said 6 weeks ago, and I quote, "This may be nothing, but I'm minded after such a fall as we've seen since last November last year that this may, just may, see some hesitation around the 327 to 325 zone. I'm not certain on that, but it's worth considering. However, the overall pressure is still bearish, and we must now consider the congestion in January that ran into early February as a possible bearish halfway hesitation. End of quote. Now, the question I posed over the last few weeks was, and I quote, where to measure it from? The most obvious immediate point is the uptick in late December, in which case it would provide us with potential down to just a little under where we are now in the low 320 zone. However, if we were to consider the move starting at the high in November last year, then there is potential down into the 270 zone, well below the bottom of my daily chart. It is still too early to say whether the 270 zone will become a target or not, but it is worth considering. End of quote. Well, it seems at the moment that such a question was too early, as prices utilized the extension of the descending triangle as a base and rallied back up through the 61.8% absolute Fibonacci line at 336.30, and even briefly over the green highlighted short medium moving average, currently at 340.30, before succumbing to the bearish pressure this moving average exerted. This seemingly defines where we can see the topside pressure coming from, and that's the slowly declining short medium moving average. For a while, mainly during March, it looked like all this was within a very recent and possible larger pattern, a March-based bull channel, currently 348.20 to 365.40, which I've highlighted in bright red on my daily chart. These two forces clashed last week and prices pitched down out of the red highlighted bull channel and tried to test down to the extension of the descending triangle once again, but have so far failed. There is not enough information now available to draw a preliminary mid-January to late March bearish Andrews pitchfork. Sorry, there is enough ammunition to information as well to draw this preliminary mid-January to late March bearish Andrews pitchfork. Now I know this is why I'm a bit curious about it. Now I know that this is somewhat optimized, but we are seeing prices track along the bearish upper time, now currently at 338.5. And once again, this is ably reinforced by the highlighted green short medium moving average. So please keep an eye on that one for the next couple of weeks. Finally, I will raise once again the one key feature I need to repeat and emphasize here, as I've done so in the past. I raised it as a possible feature 43 weeks ago, and it came to fruition at the close of 2023. It was that the whole of 2023 was an annual key reversal down last year. This hangs over all of this market more than anything right now, and all action should be seen in the shadow of this pattern. Chicago soybean oil. At the turn of the year, the market broke down through the 38.2% Fibonacci line at 48.95 that had held up prices over November and December last year. At that time, it looks as if the market might form a very extensive bearish halfway hesitation, potential being as low as below 40 even. However, the decline was a lot shallower than in previous moves lower. This was possibly dictated on top at the time by the green highlighted short medium moving average, currently 47.20. Prices went down to the area of congestion we saw last in May 2023, consisting of 3, possibly 4 bands. There are 44.68 to 45.04, made up of the 2014 high of 45.04 and the May 2023 low of 44.68. Then we have the tight 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line of 43.80 and the April 2014 high of 43.94. Then the interesting 42.65 congestion, which has the neckline highlighted in bright red of the October 2019 to February 2020 head and shoulders top, running just above it, and that's currently at 43.23. I mention all of these because some 40 weeks ago and numerous times since, I said the following about the big descending wedge pattern that was on my daily chart back then and is now high up off the top of my daily chart. I said the following, and I quote, "I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern." End of quote. This is a big pattern idea, and the market decline since autumn of last year fits in with this idea, with the expectations I voiced of eventually witnessing a fall down to the area of the May and June lows between 48 even and 46 even zone, which is where we've recently been. I've often stated here that I am keeping a very, very close eye on this idea. Is any... Oh, damn it.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.